You open your banking app, and instead of that familiar wave of dread washing over you, you feel something unexpected. Calm. Maybe even a quiet sense of control. No mental math, no guilt, no quickly closing the app before the number sinks in. That shift has a price tag. And it's not $1 million. It's not even 6 figures. Most financial advisors will never tell you about this number because it's not glamorous enough to build a course around. But it is, without question, the most important financial milestone you'll ever cross. That number is $20,000. On this channel, we break down the real psychology and mechanics of wealth building, not the motivational fluff, but the evidence-based strategies that actually move the needle for people in their 30s and 40s who are serious about financial progress. If that's you, subscribe and turn on notifications so you don't miss what's coming. Now, let's talk about why $20,000 changes everything. Most people think about wealth as a straight line. You save a little, it grows a little, repeat. But that's not how it actually works. Wealth building is defined by thresholds, invisible lines where the rules of the game fundamentally shift. $20,000 is the first of those lines. Think about what happens when you push a heavy object across a rough surface. Getting it moving requires enormous effort, but once it's in motion, maintaining momentum takes far less energy. Your finances work the same way. Below $20,000, every dollar you save feels like you're fighting friction. Above it, that friction begins to work in your favor. This isn't just a metaphor. There's a measurable psychological and mathematical reason why this number matters so much. When you have little to no savings, your brain operates in what behavioral economists and psychologists call a scarcity mindset. This isn't a personal failing, it's a neurological response. Your brain treats financial instability as a threat, and when it perceives a threat, it narrows its focus. The result? You make short-term decisions at the expense of long-term outcomes. You accept the first job offer rather than negotiating. You stay in a role that's gone stale because the risk of leaving feels too high. You say yes to things you don't want because the alternative feels dangerous. Research from Vanguard found that even a modest emergency fund of $2,000 improves financial well-being by 21%. Not because of what $2,000 can buy, but because of the mental space it creates. When you extend that buffer to 3 to 6 months of living expenses, which for most people falls around $20,000, something more significant happens. Your brain stops managing threats and starts identifying opportunities. Let's look at the numbers, because this is where it gets genuinely exciting. Assume you're saving and investing $1,000 per month at an 8% annual return. Reaching your first $20,000 takes approximately 19 months. That's a year and a half of discipline and consistency. It's not easy, and most people abandon the process somewhere in the middle. But here's what changes once you cross that line. Your second $20,000 doesn't take 19 months. It takes about 17. Because now that first $20,000 is generating returns alongside your monthly contributions. You're doing exactly the same work, saving exactly the same amount, but the timeline is already shrinking. By the time you're working toward your third $20,000, the acceleration is even more pronounced. And when your portfolio reaches $400,000, compound growth can generate that same $20,000 in just 5 months with no additional effort on your part. The math isn't complicated, but the implications are profound. Your money begins doing work you don't have to do. One of the most persistent myths in personal finance is that wealthy people have access to fundamentally different investment vehicles. In reality, a 10% annual return on $2,000 produces $200. Applied to $20,000, that same rate produces $2,000. The equivalent of a meaningful month's worth of progress, generated automatically. At $20,000 invested and growing at 8% annually, you're looking at approximately $1,600 per year flowing into your account without any additional contribution. That's not a bonus, that's your existing capital working as a second source of income. The strategy doesn't change. The index funds are the same. The brokerage account is the same. What changes is the scale, and scale is what transforms percentage gains into real financial momentum.
Here's what most financial content misses entirely, and it may be the most important point in this video. The act of saving $20,000 from zero doesn't just put money in an account. It rewires how you think, decide, and operate with money. Consider what it actually requires. You had to track spending with real intentionality. You had to decline things you wanted in favor of things that mattered more. You had to hold your discipline over months, maybe years, through competing priorities and unexpected expenses. In doing that, you proved something to yourself, that you are someone who can control money, not someone controlled by it. That identity shift is not abstract. It directly affects every financial decision you make going forward. Before you hit $20,000, a $4 coffee could trigger a spiral of mental accounting. After you cross that threshold, you've already demonstrated the discipline for the decisions that actually matter, which frees you from agonizing over the ones that don't. There's another shift that happens at this level that rarely gets discussed. When you're living close to the financial edge, every unexpected expense is a crisis. A car repair, a medical bill, a rent increase, each one derails your month and resets your progress. You spend enormous mental energy managing emergencies rather than building momentum. With $20,000 as your foundation, those same events become inconveniences. They're still annoying, but they're not catastrophic. And with your threat response no longer dominating your thinking, you start noticing things that were always there but previously invisible. A former colleague mentions they're raising a small round for a new business. Before, you'd file it away with mild interest. Now, you can actually evaluate whether $5,000 makes sense as a calculated risk. A property in your area is listed below market value because it needs work. Before, that wasn't even a real option. Now, you can run the numbers.
Something counterintuitive happens to your approach to spending once you have a solid financial foundation. You stop obsessing over small expenses and start paying far closer attention to large ones. When money feels scarce, every purchase becomes a micro-negotiation. Name brand or generic, coffee from a cafe or made at home, premium fuel or standard. These decisions consume cognitive energy disproportionate to their actual financial impact. The difference between daily coffee at home versus buying it out amounts to perhaps $1,000 per year. Meaningful, but not transformative. What is transformative? Your housing costs, your vehicle choice, your investment allocation, your income trajectory. These decisions can swing your net worth by 6 figures over a decade. Once you understand that distinction clearly, you stop sweating the small decisions and start engineering the large ones. That shift in focus doesn't just save money, it saves the mental bandwidth you need to build genuine wealth.
This is where the impact of $20,000 extends well beyond your bank account. When you're dependent on every paycheck, you're negotiating from a position of invisible weakness. Your employer may not know it consciously, but the dynamic is real. You can't push back on unreasonable demands without fear. You can't explore outside opportunities because the risk feels too high. You can't ask for the raise you deserve because the downside, even a small one, feels existential. $20,000 changes that equation. It gives you what could be called a runway, the ability to walk away from a situation that no longer serves you and sustain yourself while you find something better. You may never need to use it, but knowing it's there shifts how you carry yourself. You negotiate differently when you don't need the outcome as badly. You push back with confidence instead of anxiety. You pursue better opportunities without the paralysis of imagining the worst case. And the people around you notice. Not because you announce it, but because confidence built on real security reads differently than bravado built on nothing. The result is often better assignments, stronger recognition, and yes, higher compensation. That acceleration compounds directly into your wealth-building trajectory.
Here's where a significant number of people get it wrong, and it's a mistake worth taking seriously. After months or years of discipline,
Finally seeing $20,000 in your account produces a powerful psychological response. You feel like you've arrived, like you've earned something. And that feeling is often followed by a decision that undermines everything you just built. Maybe it's a new car because you've been so responsible. Maybe it's an expensive trip because you deserve it. Maybe it's a down payment on a property that stretches you past your actual means. Resist this. That $20,000 is not a reward. It is the foundation. It is the seed capital for everything that comes after it. The moment you spend it, you don't just lose the money, you restart the compounding clock, and you return to the psychological state you worked so hard to escape.
Consider this. The average person over a working lifetime spends somewhere between $400,000 and $500,000 on vehicle costs, payments, insurance, fuel, and maintenance. That's not a trivial figure. For many people, it represents the difference between retiring with options and retiring with uncertainty. A $30,000 vehicle isn't just $30,000. At an 8% average annual return over 20 years, that capital could grow to over $140,000. Every major purchase decision, understood through the lens of opportunity cost, looks entirely different. This isn't about deprivation, it's about intention. When you understand what you're actually trading, the choices become clearer, and often you realize you want the outcome more than the thing.
$20,000 will not make you wealthy on its own, but it will fundamentally change how you relate to money, how you approach your career, how you evaluate decisions, and how you think about the future. It's the difference between surviving financially and beginning to design something. Start building that foundation with intention, because the version of you 5 years from now will reflect the decisions you make starting today. If this gave you a new way to think about money, consider sharing it with someone who might need to hear it. And if you haven't already, subscribe for more content on the real mechanics of building lasting financial security.